Succession planning, securing the future of your practice. The objective is by the end of this lesson, you should be able to discuss the reasons advisors need to plan for their exit, explain the difference between a continuity and a succession plan, describe some of the things to consider when planning, and understand the time frame when each should be done. Now, a succession plan is for your retirement or even your unplanned departure, but it's not for a quick external sale. You need to court the right buyer, you need to set up terms, and if this isn't done in advance, your family's going to have a fire sale, and they're not going to get the full value for the practice. Or if you don't plan it in advance, you don't have all the information you need to get the best price for your practice. You want to begin 3 to 5 years before the sale of the business. You're going to use the analytics that you've been keeping track, all of your operational manuals, all of the things, your value statement. You're going to look for somebody who's a good match for you so that your clients are going to be in good hands, and the person that is buying your firm is going to know they're really getting a good value. But what happens in the interim? You have an accident, there's something that happens. Every advisor should have a continuity plan, and this you need to implement right away. Now, why should you have one? Well, you plan for your clients. You should also plan for your practice. You might be disabled. You might suddenly pass away. You see so many unexpected things happen in the world, and could you imagine if something happened? Where would your clients be? How have you planned for them? And let's say your spouse was ill suddenly and you needed to step away. You need somebody who you've already handpicked that can step in and maintain your practice until you come back. So a continuity plan is actually required by FINRA Conduct Code 3510. So you really need to have something set up to protect your clients if you're not there to do it yourself. So finding the right leader is really important. They should have similar values, approach to handling things with your clients, similar standards. Again, so you can see why having all of this described is so important. It helps people find you, and it helps you find them. So it could be a junior advisor in your firm that you're cultivating to take over for you. Maybe it's a family member that's licensed and has some experience. It could be a peer at another branch office, but they're with the same firm or broker-dealer or whatever, and you agree to do each other's continuity plan so that if something happens to them, you'll step in and keep the boat afloat, so to speak, until they come back, or vice versa. But it could also lead to succession if you're not able to come back. This will help you maintain your high level of service that you've planned for your firm. It maintains your practice until you return, and you should update this every 2 years. Now, there's different types of continuity plans. There could be a revenue sharing agreement. There's a guardian agreement, a cross-purchase agreement, an option agreement, and a buy-sale or a shareholders agreement. We're going to talk about some of the ones that we've just outlined here. So a revenue sharing agreement is typically a wirehouse or a broker-dealer, or somebody's controlling all of the funds as they come in, the production. And they'll assign a split rep code. So you have somebody that if they had to step in, what they produce under their rep code is earmarked, your rep code is earmarked, and you have some agreement in place where you split what the firm earns while you're away. And so it's a temporary solution between two licensed advisors. Now, a guardian agreement is that the guardian is going to step in case something happens to you, and they're going to get some sort of compensation And then if you're not able to return, if in case of that you pass it away, they have the first right to purchase the practice. Now, if you're not able to return. Now, that doesn't mean they've committed to buying it, but they get first right to do it, and they're compensated in the meantime. So your clients are fine until the practice is sold. Now, the cross-purchase agreement is where two advisors promise to be each other's continuity partner. And this is a mandatory promise to buy each other's practice. So this is not to be entered in lightly, but let's say there's two partners in the firm, or you have two branches, or whatever it may be, but you both have already identified that this is the practice that one day the other would like to take over if you're both not there, and so you make an agreement that is a mandatory purchase. There's a valuation that's predetermined to be used, so however you're going to value the practice at the time of the sale is discussed in this document. And typically it's funded through a life insurance. And so that way you have the money to pay for whatever it is that you've decided this firm is going to be worth. Now, the option agreement for the eventual successor is a little less flexible than the cross purchase because you have to put a specific date and a specific price to sell the practice. So again, you may decide that you're going to retire at age 75. And at age 75, you do the calculations and you say you expect your practice to be valued at whatever you've predetermined and you both agree would be an acceptable valuation. And then the buyer gives a small deposit to the seller, and then that's going to be credited toward the final purchase price. And there's a contingency in the document in case they have to step in sooner. So the buy-sell agreement provides the payment terms and valuations. Again, this is also funded through life insurance most often. And there's three types of buy-sell agreements: cross-purchase, stock redemption, and hybrid. And just to give you an idea, if you look at the type of protection you're looking for, I've outlined on the slide which ones might be the right choice depending on what you're choosing. And that LTCG is long-term capital gains, because remember, when you sell a practice, you're going to have a gain that you're going to recognize, and how you recognize that is going to impact your taxes. So succession planning, where to begin? You want to do a detailed review of who's indispensable to your practice, because those are people you want to make sure you set up to retain, because that helps you maintain the value that you're stating that your practice is going to be worth. You're going to look at their professional goals and try to cultivate them and give them an area to advance and move on their own career track so that they stay there. You may want to have the right life insurance and liability insurance or key man insurance, all of those things in place. You might want to set up a 401k or a pension plan or something that's going to retain those top professionals that are supporting your valuation so that they will stay. Now, you want to eliminate firm debt, because again, if you're trying to make this practice attractive to sell and you want to get the best price, you don't want to carry a lot of debt. You want to make sure you have a formal business valuation, and you want to hire outside experts, somebody that does this, helps match buyers and sellers, an attorney, a CPA, people that are going to be on your team here to make sure that you get the best price for your firm that you've spent all these years setting up and cultivating, and you want to make sure that you do it correctly. So you do want to begin early. We talked about at least 3 to 5 years for your succession plan. You want to identify things that can increase in value or that have standalone value. So standalone value might be the building, if you own the building that the practice is on, or maybe machines or things of that nature that have separate values from the actual revenue that comes in. You want to formalize the process. You want to have lists of a timeline, your transition method if you decided to use the terms, and of course your successor. So your saleable assets are like the land and the building, the goodwill. There's a value to that, the goodwill you've created with your clients. That non-competition, non-solicitation. You want to make sure that if you sell this practice to your junior advisor, that you don't start your own practice again and take all your clients away from them. In other words, that's usually included. And then consulting agreements. They may decide to keep you on for a year or so during the transition, and they'll compensate you for helping with the transition and consulting with your clients and helping them maintain that level of service and all of the individual things that your clients like and know about the practice. It's nice to have that advisor there to make sure the transition goes smoothly. Now, the pricing of your practice is going to be based on the terms that you'd agree upon, and the value, the interest rate is going to need to be documented. And also, there needs to be something in there if you fail to meet those agreement terms. So you agree and you sign to buy this practice, or somebody wants to buy your practice and then they don't follow through. There has to be a consequence in there. So some of the financial considerations include, other than the financial terms of price and payment terms and type of sale, will be the down payment and maybe an earn-out where the advisor gets their compensation over a period of years. It could be grants or warrants and an employee stock ownership plan. Those kind of things might be offered if it's a corporation. We talked about the consulting agreement. Now, we talked about this earlier about tax implications. So there are common ways to be paid. It could be a cash down payment. It could be installment notes. It could be the non-compete and consulting agreements. And there are tax implications if it's long-term planning versus a short-term sale. You can imagine how all of that profit is realized and how that could impact the taxes of the seller. So the buyer as well, we want to determine how this is structured, if it is the most advantageous to both the seller and the buyer. So it might be incremental sales to a family member, it could be fractional sales to a junior partner, it could be a merger with another firm. So all of these things need to be determined, and that's why you need a CPA and an attorney involved in this. You must both agree, of course, to the allocation. Each asset might be a percentage of the total sales. So if you're going to sell one off, how that's valued, those things need to be done. When cash is received, of course, can influence the tax liability. That's such an important thing that everyone should be focused on, but is often overlooked. And then a consulting agreement, again, if they're going to want to consult this advisor to, talk to me about this client, help me understand what they need. I see your notes, but I really need to understand them. You should be compensated for that as a seller. Make sure that you think about that when you're setting up your agreements. And then the payment at the point of sale, or post-transaction. So you're going to address that transition. How will it take place? The longer the transition period, the greater chance your clients will trust you as a successor. Now, you can see that this is a very necessary thing to do. It requires some expertise. And so this is a great niche opportunity if you really like doing these kind of puzzles and helping connect to businesses. This might be a great niche for you. There are designations available to specialize in helping firms do this. One's a certified exit planner, and the other one is a certified exit planning advisor. So you might want to look into either of those if you think that this might be a great way to specialize. So in summary, you learned about the difference between a continuity and a succession plan. You know why now you need both for your practice, and you've got some considerations when you plan for your firm.